Iron ore has declined today after a two-day gain that was supported by signs that Chinese demand might pick up after being weak for a while. Let's talk to an expert in the sector. He is Reid I'anson, senior commodity analyst at Kpler. We're going to talk about this. We're going to talk about some natural gas as well. What is going on, Reid, with the global iron ore market? As always, China and perceptions of Chinese demand are a huge influence.
Yeah, of course. I think it's important to keep in mind we kind of level set where we've seen the price move recently. We kind of had a run up earlier in March and April, but prices came off again early this month, largely driven by two factors. First, of course, concerns around the Chinese property market, which have been ongoing for years now. But also we've seen an uptick in supply, especially out of Australia. Last month, we saw volumes leaving Australia push to around 79 million tons, and we think that they'll probably hit that level again this month. That will be a year-to-date high, and those factors are both weighing on the price of iron ore right now.
In some notes that you've provided us with, you note that a lot of, I believe, Chinese steel production, steel, of course, made with iron ore as a huge input, is being re-exported given the weak domestic demand market in China. How is that a factor in all of this?
It's a huge factor. Interestingly enough, both, when you calculate both domestic Chinese iron ore production plus imports, they've maintained at relatively elevated levels over the past couple of years because smelting capacity has also maintained at elevated levels. And this is surprising when you look at the state of the Chinese property market. But what they've been doing, smelters have been doing, is re-exporting steel abroad to places like Brazil. There are broad questions, though, around whether they can continue this moving forward. We've seen countries like Brazil, who were becoming very large importers of cheap Chinese steel, implement heavy tariffs a couple of months ago. And this followed 8 or 9 months of deliberations around whether they wanted to implement those tariffs, but ultimately they moved forward and did so. And I think we're going to see more of this, more broadly across the globe as countries look to protect their domestic steel production industries. And so there are broad questions around whether China can maintain this steel production to export-led growth model. There are signs, keep in mind, that local governments are looking at potentially trying to limit steel production within several provinces over the next several months. So we'll have to keep an eye on it.
Okay, let's move to natural gas. Liquefied natural gas is a big topic among commodities-aware investors in this country as LNG projects in this country finally show some signs of meaningfully advancing. You think U.S. nat gas prices are getting support from LNG demand?
I think by early next year, that's absolutely going to be true. We're in this interesting situation right now where the last couple of years, the U.S. hasn't added that much LNG capacity. But next year, the ramp up will continue that, we've seen over the last, decade or so. And that is helping to pull, more broadly, helping to pull Henry Hub closer to, those international benchmarks, your TTF price in Europe, your JKM price in Asia. And so this price convergence will continue to show itself over the next several years, especially as we see LNG build out in the United States. Keep in mind that next year, we think capacity could expand by 35%. Now, keep in mind that our view on Henry Hub more broadly is that the increase in price we've seen recently is largely driven by cuts to production. However, this summer, I think that demand will be quite strong. And so even before we see this additional LNG capacity coming online late this year, early next year, we still think Henry Hub will find support, one, again, because of the declines in production we've seen and because of a pretty strong summer demand profile as well.